Good morning. How banks, agencies, CMBS, and debt funds price their interest rates. And we'll dive into understanding the mechanics behind commercial and residential mortgage pricing. One of the most common questions borrowers ask is simple on the surface but complex underneath. Why is my rate different from another lender's? Well, the answer lies in how banks, agency lenders, CMBS platforms, and debt funds price their capital, and how each group interacts with primary and secondary mortgage markets. And understanding this framework helps borrowers set realistic expectations, evaluate loan options intelligently, and avoid costly timing mistakes. Now, this article breaks down the methodology, the indices, and the market forces that ultimately determine the interest rates lenders can offer. So let's look at the primary versus secondary mortgage markets, and this is the foundation here. So your primary mortgage market, this is where loans are originated. So borrowers are going to interact directly with the banks or the mortgage brokers or the agency lenders or the private debt funds. And rates here are quoted based on current market conditions, the underwriting risk, and where the loan will ultimately be held or sold. Now, there's the secondary mortgage market, and this is where loans are sold, also securitized, also pooled, and traded by investors. And some of these key players include Fannie Mae and Freddie Mac. You've probably heard of those names, but also CMBS bond investors, as well as insurance companies and pension funds and hedge funds. And the point here is that secondary market demand directly influences the primary market rates. Now let's take a look at how banks price their interest rates. So there's a primary index that the banks really tie off of, and it's SOFR, which is formerly known as LIBOR, or prime rate, or the U.S. Treasury's short to intermediate duration. And here's their methodologies. They have an index plus a credit spread. So the key inputs are the cost of their deposits, what they have to pay their banking customers, and any regulatory capital requirements, and the relationship value, as well as the loan to value of the request, but also the debt service coverage ratio or DSCR, and they evaluate the sponsor strength. And why bank rates may look cheaper? Well, they have stable balance sheets. They're usually at a lower leverage position, and they're often relationship driven pricing. And the trade off there is that they can be more conservative underwriting and a little slower on the execution side. Now, let's look at how agency lenders, think Fannie Mae and Freddie Mac, price their loans. So their primary index is tied to the US Treasuries, so a 5, 7, or 10-year US Treasury. And their pricing formula is the Treasury yield plus the guarantee fee that the government sweeps and any credit spread. And here's the key characteristics. There's a highly liquid secondary market. So the tight spreads due to the government backing have a little bit better pricing, and they have standardized underwriting. So what can impact the final rate? Well, Treasury volatility is the number one reason. There's often a prepayment structure, so often yield maintenance versus defeasance that keeps you in a loan for the maturity. And there's also a large market appetite for multifamily bonds. And the result is agency rates are often among the lowest, but the most rigid in their structure. And how CMBS lenders price their interest rates? Well, there's a primary index. Much like agency, it's a corresponding treasury based on the loan term. There's going to be a CMBS bond market spread. And here's their pricing formulas. They got the treasury plus the CMBS credit spread and any structure premium. So the key variables are bond and investor demand, because you have to have buy an A piece and a B piece. There's a property type risk. There's market liquidity concerns, and there's also loan structure complexity. So an important insight here is that CMBS rates can look attractive before volatility, but also widen quickly when bonds markets reprice the risk. Now let's take a look at how debt funds price their capital. Their primary index is SOFR almost exclusively. And the pricing formula is there's the SOFR Treasury rate plus a large risk premium. And their spreads are a little higher because they're not going to require bulk deposits like a bank. And they have a higher cost of capital because they have to borrow it on the secondary market. And they have a targeted return threshold to return to their shareholders. And their transitional asset risk could make them attractive on a deal. But what borrowers will gain is speed, flexibility, higher leverage, and creative structures. And the debt funds price risk, not relationships. So let's take a look at why rates change daily and even hourly. Interest rates move because treasury yields fluctuate, and bond investors reprice their risk. And also, inflation expectations shift. But not to mention, the Federal Reserve policy could signal a change in their comments or through an interest rate cut. But liquidity enters or exit the system is another reason they could toggle markets. And a rate quote is really just a snapshot of global capital markets at that moment in time. Now let's take a look at why working with a mortgage broker matters. A mortgage broker tracks multiple indices simultaneously, and they understand secondary market behavior and can explain it to you so it makes sense. But they also know when spreads are tightening or widening. And part of our job is to match the right capital source to the borrower's strategy. So rates are not just numbers, they're expressions of risk, liquidity, and timing. And here's the final takeaway. Interest rates are not arbitrary. They are the outcome of global capital flows, investor demand, risk modeling, as well as market structure. And borrowers who understand this framework can make better financing decisions, but also avoid surprises at closing. And that, my friends, is something we don't want. I'd love to chat with you more. Please visit billraponline.com to figure out how to get a hold of me, and I'd love to talk. Have a good day.